Assalamu alaikum student, hope you are fine. Now the week fifth is going to be start, and the lesson notes are shared with you people. And lesson title is again that's chapter number 3, capturing the economic events. And the half portion we are doing in a week 4, and the remaining portion in which we will learn about the income statement transaction and income statement accounts. Detail of income statement account we will cover in this week. Fine. And the learning objects of this lesson notes that are related to explain the nature of net income, revenue and expense, and further you will be realize about the some accounting principle, I mean to say realization and matching principle in recording the revenue and expense account. And third learning objects are the how revenue and expense transaction are recorded in accounting system. And for the last one is you will be understand the cash book and bank book. Okay, that's of all learning objects. Similarly, you can find your this material from your chapter number 3, your recommended book. And student need to be able to learn these important points, and as you will come in your class, that's the most discussing question among you people are the net income, revenue and expense. You need to be under good understanding about by their definition, and share your understanding to your class fellow about the net income, revenue and expense, and similarly realization and matching principle, and revenue and expense transaction. And you have to know about how the transaction is going, and their debit credit rules, and how to read the transaction, and further cash book and bank book. Okay, now we can start our lecture. What is the net income? The net income, that's one of the important thing for the business entrepreneurs. A business is going to be start just for to earning. The net income, that's net increase the owner equity. By technical accounting terms, we think that is basically a point that increase the owner equity and result from the profitable operation of a business. Okay, if we say business is going to be a profit, then you need to be understand your net income will be increased, and it will increase the owner equity. Secondly, net income does not consist of any cash and any other specific asset. Many people have I guess in my childhood I will also think about that. If we get some profit from our business, net income is the 100,000, like that. If I find any, I guess like if you say we earn 1,100,000 in this year, and this 100,000 will be maybe a cash, as I will in a form of cash. Okay, it is a net profit. It is a net profit of any years, and it is a form of a cash we can get, and it may be in our bank account. But that thing, it is a whole accounting period. It may be a month and a years that you are doing the work, but it doesn't mean 100,000 is a net profit, and your cash is in balance sheet showing this value. Okay, the cash is basically increase and decrease on different terms, like owner are going to be invest in a business, more cash is coming, their cash will be increased. You are purchasing some assets, and you are purchasing your inventory for your business operation, then cash will be outflow, then the cash have a separate thing. Okay, cash not mean to net profit all are in the form of cash and you can view in your balance sheet. It is a no. Also the net income does not consist any cash and or any other specific asset, but we can say that your net income will be increase the account cash, because as you are going to be provide the sale like your customer and you say we are doing a sale, then the other account that will be used is a cash. Okay, then indirectly we can say in the income statement or in a earning in net profit or a earning that is producing our cash increase and asset will be increased, but the value of net income and net profit not come in the whole value that will be in the cash account. Okay, this that is a graphical some point are will be cleared in next, but there now net income is a competition of overall effect of many businesses transaction on owner equity, and as I will discuss that asset increase as income is earned, either it will be the asset is increased and liability will be decreased. Okay, liability will be automatically increased because as the cash will be received, you will be able to pay the cash. Okay, you will able to pay your liabilities, and then as cash as asset will be increased, your business in this way easily paid the liability. Okay, and further is the owner equity, and yes, it is the one main point. Your owner's equity have directly linked to the net income. As the net income will be increased, it means your retained earning account will be increased and your owner equity will be increased. So the net income always the result in the increase of a owner equity. Fine, these are the some concept that we are going to be discussed. Your net income increase your asset as well as your owner equity, and it will be decrease your liability. Fine, now we move on to next. What is the retained earning? Word retained earning, you know that is a part of owner equity. If you have idea about the balance sheet format, some account we discuss in our balance sheet, retained earning that's appear in the stockholder equity section of the balance sheet. Yes, retained earning is a income causes the balance in the retained earning account will be increased as your earning your net income will be increased, then your retained earning always going to be increased. Okay, many corporates follow the policy of distributing their stockholders some of the resources generated by profitable operation. You know, when the income will become that it will be added in the retained earning, and from the retained earning account, by using the retained earning account, that is the one of a saving account, reserve account of a company, from which a company can use for the further investment at a secure amount, and also from the retained earning we can withdraw and distribute some money among the shareholder, and that distribution will be called the term dividend. So the dividend is a term just defining that it is a portion of a profit and the retained earning that is distribute among the shareholder on annually. Okay, now as a company give the dividend, that's showing the reducing balance in a retained earning. Okay, the reduce both total assets and stockholder equity. Reduction in stockholder equity is reflect to decreasing the balancing of a retained earning account. Okay, then what going to be happen with the retained earning and assets and owner equity? That is some rule we will be defined, and revenue and expense what will be, it will be debit and credit what happening with them. Okay, The balance in the retained earning account represents the total net income of the corporate over the entire life of the business, less all of the dividend to its stockholder. And stockholder, in short, retained earning represent the earning that have been retained by the corporation to finance growth, right? And the revenue, what is the revenue? Just word revenue, we already discussing it. Word revenue, it is just price of goods sold and services rendered during a given accounting period. Remember, I'm going to recall that that's the price of goods and services. Okay, revenue is the price of goods are sold and services rendered to the customer during a accounting period. So the earning revenue causes the honor equity will be increased. Okay, when business renders services or sell merchandise to its customer, usually you will receive the cash or require an account receivable from the customer. That's inflow of cash and receivable from customer increase the total asset of the company. Other side, accounting equation honor equity increase that to match the increase of total asset. So the revenue is a gross increase in the honor equity resulting from operation of a business. Now we talk about the realization and matching principle. Let's say the realization principle indicate that the revenue will be recognized at the time of goods are sold. Okay, let's say revenue will be recognized at the time of goods are sold or services are rendered. At this point, business has essentially completed the earning process, and the sale value of a goods and services can be measured objectively. At the time of prior the sale, ultimately value of a goods or services sold can only be estimated, but after the sale, only step that remain to collect from the customer, usually relatively certain events. So you should keep in your mind realization principle said that revenue will be recognized at the time of goods are sold or services are rendered. Now you can write it in your income statement, you can report easily whatever the cash is received at the time of the sale or not. Okay, but your revenue will be earned and you can report in your income statement. Second is the expenses. If we talk about the expenses are the cost of goods and services used up in the process of earning revenue. It is the cost of goods and services. It is the cost of goods and services used in process of earning the revenue. One thing and the one definition is going that whenever we are going to be earning revenue, then we are using the cost. Some we need to bear some cost of goods and services. Example include the cost of employees, salaries, advertising expense, rent, utilities. Okay, that all are expense, and it will be recognized when we are use the thing. Okay, and now the second principle of accounting related to revenue and expense, matching principle, very important. Matching principle, when we can record the expense. A significant relationship is existing between the revenue and expense. Expense basically are incurred the purpose of producing the revenue. Why we need to bear expense in every business? The logic behind this is we are basically want to earn some money. We are producing some revenue, but for this earning the revenue, producing this revenue, we need to be incur some expenses. Okay, in the measurement of the net income for the period, revenue should be offset by all expense incurred the producing that revenue. This concept of offsetting the expenses against the revenue on the basis of cause and effect of the called matching principle. Okay, simply matching principles tell you people that you can write up the expense if this expense is basically producing the revenue of this specific accounting period. Fine. And accrual based accounting. accrual based accounting said that policy of recognizing the revenue in the accounting record when it is earned, and when it is earned, when the product will be delivered to the customer and services are rendered, then we can see, we can recognize revenue is the earn and we need to be write up. Okay, and recognizing of the expense when the related good or services are used or are consumed is called accrual based accounting. Okay, the both definition of expense and revenue are going, whenever you will be able to write the expense are occurred when the things are used, like utility, some units. If you have faced the electricity bill, how you can face the electricity bill, 200 and 300 unit are consumed first, then electricity bill become. Okay, that is thing that are you expense always that you will be use and consume the things. Okay, that's related to accrual based accounting concept. Now we can debit and credit rule of a revenue and expense. We have normally already know about, but I'm going to be repeat because we need to be do a transaction in further step. So increase in owner equity are recorded as a credit. You know that the debit credit rule of owner equity, just remember it. We make a T and tell increase in like owner equity, it has a credit balance. Okay, and increase in owner equity will be, what will be, it will be credit, we write it is a credit. Okay, decrease in the owner equity, it will be the debit. Fine, it is already discussing when we are using defining the rule. Similarly, that's increase in owner equity are recorded by credit. Okay, and decrease in owner equity recorded by debit. But the rule is extended to over a revenue and expense. Revenue increase the owner equity. Okay, revenue increase the owner equity, therefore revenue is recorded by credit. Okay, and the expenses decrease the owner equity, therefore expense will be recorded as a debit. Fine, that is a basically rule that I am going to be revised. Revenue are increase the owner equity, so we'll write it in the credit. Revenue always record in a credit, and expense always record as a debit, because that is decrease the owner equity. Okay, now I can talk about the dividend. Now the dividend, that's related to a separate account. It is not a part of a chart of account. I mean, it is not a expense, it is not revenue, it is not a liability and assets and owner equity. That's a separate. It maybe you can say that is the sixth one. Okay, what is a part of a retained earnings? Sometime we include it in the retained earnings statement. Dividend, that's a distribution of an asset, means the cash. The company earned the cash, but the company earned the cash, but it will be distributed among the shareholder, and it is a reducing, showing the reducing balance. In some respect, dividend are similar to expense because this reduce both assets and the owner equity in the business. You know, if in a retained earning account we have a 100,000, but owner withdraw 40 to 50,000, owner will withdraw, means the cash will be decreased that time. Okay, however, dividend are not expense, but they are not to deduct from the revenue. It is not expense because it is not deduct from the revenue. We are using it after revenue. Okay, as the net income will become and it will be added to the retained earning, then we are going to be decide we are give some money to the shareholder and the owners. So that's the reason dividend are to be not a expense, but that treatment as a look like expense because it is a